You just have to know that it is still a risk and you can win really, really big or you can not win at all.
A little bit about Tanya. She is a real estate investor, house flipper, and short-term rental owner in Minnesota. I got the state right? Okay.
Yeah.
She started out 11 years ago as a commercial project manager, then moved to residential real estate investing in 2018. So welcome to our show.
So yeah, you've got a lot of experience from a personal level on passively investing and working with passive investors. So, well, what are some of the benefits that whether it's personally or just talked with other investors that they're really looking for when they're considering passively investing in real estate?
Yeah, so some of the things that I think of, like I have a lot of conversations with people about passive income because obviously, like being in the real estate investing world, I want people to give me some of their money, but on the flip side, I still have money to give as well because I have accounts. Like I have a 401k account that I can't lend to myself, or a portion of it can't be lent, so I lend it out to somebody else. So when I think of the people that are lending just in real estate, whether it's with 401k, IRA, or their personal funds, I just think about the kinds of goals that they have. Like, I think those are some of the most important things. So if you're like interested in lending your own money to somebody, I think asking questions and finding out what you don't know yet. So, because it's kind of hard when you have no questions yet.
Mm-hmm.
So, like, I've never lent before. So you should be like, whoever you're talking to that you're considering lending to, you should know, like, and trust them, obviously, because that's the person that you're kind of investing in. And then you should be asking them, like, what don't I know? What kinds of things should I be looking for? Whenever I have those conversations with people, I try to encourage them to ask the questions and to just be okay with not knowing things, but also, you got to find out things. Like, everybody has to start somewhere. So just asking a ton of questions is a really good idea on the front end anyways.
Yeah, and I would actually add to that. Listen for the investor, like the person that's sinking your money. Listen for them to ask you questions about your goals, because if they're not asking you what your goals are, I mean, it's not that anything, like, it's not necessarily a huge red flag, but that's part of relationship building, and that's also to help make sure that you're going to be a good partner for them, because it goes both ways. Like, a bad passive lender with like misaligned goals with an investor is going to be a headache for the investor. And it's definitely not going to be a headache for the passive investor. So those questions go both ways.
Yeah, and like on the front end, you want to know, like, as a person that's taking somebody's money as well as a person giving away my money, I want to know how long you need the money for, like what kinds of things, like what are you going to do with the money, and then like those questions, they're so important because you want to know, like, is this person's, like, I encourage people, if it's actually just your savings account money, if something happens at your house, like I'm looking at my AC unit, my furnace and stuff like that, if stuff like that goes out, is this money that you need for that AC and furnace? Because you can't use that, or you don't want to use that kind of money. You can't use emergency money in real estate, or you shouldn't, because this person might need it for a year, 2 years, 5 years. Like, it just kind of depends on who you're investing with. So those are the kinds of things, right? Like, you want to know what that person's goals are, and then how can you cater, your use of that money, or your use of giving that away. How can you cater that to me and, my lifestyle, I guess.
Now, any type of passive investment, taxes are a part of the equation, and they never, at least in my opinion, they never should be the primary reason why you invest. But it is a huge benefit, especially if the investor has, strong W-2 income. What percentage of investors, really look for the type of investments that are going to provide them with strong, deductions, that these equity partners that are really looking for passive losses in addition to a strong return on their money?
Yeah, so in my world, I'm typically doing a lot shorter. I don't need a loan personally for more than a year most of the time. So the kinds of tax advantages don't really come
Yeah,
Like,
so they're more hard money, right?
yeah, well, no. Actually, they're still like it's still a private lender. It would be a person that has
Yeah,
$50,000 sitting around.
that's what I meant. It's an individual
Yeah,
person that's
and
like
those
their own
people,
organism.
well, that's what I meant. I was gonna say, most of those people don't like they're not well versed in that. So it's my
Mhm.
job to make sure either they're well versed or that my CPA reaches out to them when we need to actually do paperwork or anything like that, or send them things at the end of the year for taxes. So the people that I use are again, they're just a little less versed in stuff like that. You definitely get that when I have somebody that's a real estate investor already that's been around for a few years and has a few $100,000 sitting around. Those are the people that care about that. So I would honestly say it's probably 80-20. Like 80% don't understand the tax advantages, whereas 20% do.
That actually, so that last part, I agree with, and I see it,
Mhm.
but that also makes it incredibly important for the
Mhm.
passive investor to vet who they're working with, because you said 80% that they're just uneducated on various aspects, and maybe to a high degree. But that also puts them at exponential risk of
Yep.
potential fraud if they, and maybe not even fraud, but just not knowing the right questions to ask and how to underwrite the sponsor and underwrite the
Mhm.
opportunity, because a well-meaning sponsor could still be incompetent or not experienced enough to execute the plan.
Yeah.
Fraud is a wholly different story, but it's still
Mhm.
risk.
Yeah, I think it is too. But that's why I had mentioned in the front end, it should be somebody you know, like, and trust. They should have a couple of years' experience. If it's not, they are hopefully being upfront about that. Because some people, I remember the first time I ever got money given to me for a deal, and I was super upfront about it. I said, like, hey, I haven't done this deal, or I've only done 2 flips, or this is my background. So I think just vetting the person, like knowing that, like, personally, I give personal guarantees. So if something happens with that real estate, they can come back to me
Yeah.
personally to get the money. But I think it's just having some of those things in place. You can always talk to an attorney about it prior, but just asking a lot of questions and actually checking references. Like I can give references to anybody, but the person that I lend my money to is a flipper that I know, like, and trust. So, like I know
Yeah.
she does her paperwork. I trust her, and that's the risk that I run, though, giving her my 401k money. So you just have to know that it is still a risk, and you can win really, really big, or you can not win at all.
Yeah, and you're typically limited to whatever you invested.
Yep. Yeah.
So by that, just like you said
Very
before, like it
common.
shouldn't be your life savings money.
No.
This is your investment money that you could afford to go to zero, which
Mhm.
when done properly, when vetting properly, it's, that's less likely to happen,
Mhm.
especially if they have a track record. And if they're providing like personal guarantees and things like that, it adds to the risk profile.
And you can
Um,
start small. Like I know plenty of people that you just have this inkling when they give you some money. You're like, I bet you that person's sitting on 1 million, but they only start with 100 or 50,000.
it
Like you
always
can
works out that
start
way.
super small. So
Always works out. Yeah,
I
yeah,
think
and
it's
you'll see that it's like you do the first deal and they only had 75,000, and then the next deal they
great.
suddenly have like 500,000.
Yeah, which is
um,
great. Like just treat it like you don't have to always give all of your money away to anybody. You should still diversify a little bit, um, and have good paperwork.
Totally agree.